Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello, everyone. Welcome to today's Top Stock Pick. I'm Jeremy Mullen, and I will be doing Bloomin' Brands. This is ticker symbol BLMN. The stock is a Zacks ranked #1 strong buy that owns and operates casual, upscale, casual, and fine dining restaurants. The company's family of brands includes the popular Outback Steakhouse, but also includes Carrabba's Italian Grill, Bonefish Grill, Fleming's Prime Steakhouse and Wine Bar, and Aussie's Grill by Outback. The stock has performed well in 2023, trading up as much as 40% after a solid earnings report back in February. However, the stock has dropped almost 15% since. I like the stock here as it approaches some support levels, but before we jump in, let's take a closer look at the company. Okay, here is the profile page. We have Bloomin' Brands, Zacks ranked #1. You can see the style scores here. We have A in value, B in growth, and B in momentum. I really want to focus on that value. If you come down here and look at the forward PE, you see a forward PE under 9. So value investors really like that. For other investors, additionally, we have a dividend of 4%. So that's a nice dividend for a restaurant stock, and it is valued at $2.1 billion. Let's look at the next screen. We're going to take a look at the earnings over the last couple of years. So you can see the COVID crash wasn't good for the stock or investors. With everything closed, obviously a lot of restaurants were shut down. They lost a lot of sales, but they bounced back nicely, right? We have 12 earnings beats since COVID. And obviously when everybody had to get out of the house, we saw some tremendous beats back here, which took that stock to all-time highs. And since we've kind of consolidating, but the company's really still doing well. We had an 8% earnings beat there in that last quarter. Kind of digging into that quarter, the company reported 68 cents versus 63 expected. Revenues did come in below expectations, but the company guided Q1 at 85 cents to 90, which is above the 85-cent expected. So they lifted their range there of what to expect. Fiscal year 23 looks really impressive. They guided higher and now see $2.91 to $3 versus the $2.67 expected. Operating margins that were up year over year despite significant inflation. So management is really doing well, controlling costs on the inflation side, despite sales kind of slowing down. The company raised their quarterly dividend by 71%, authorized a new $125 million share repurchase program. So they are returning cash to shareholders two different ways there. So let's look what the analysts are saying. We look at the earnings estimates. We can see we have revisions higher across the board here over the last 60 days and one revision lower over the last 2 quarters. So you can see over the last 60 days, we've ticked higher from 85 to 87 cents, so going in the right direction. Over the next quarter, 61 to 70 cents. This is a nice uptick too. But looking in longer term, it looks even better. We have a jump of 9% for the current year, which has to do with that guide higher. And then for next year, looking pretty good as well. That's a 10% move higher there. So what are the analysts saying outside the estimates? Well, they're taking their price targets higher. JP Morgan took their targets from $26 to $30. Credit Suisse went from $27 to $31. But Raymond James is the most bullish. They went from $30 to $33, and they rate BLMN with a strong buy. That is about a 30% upside from current trading levels. So that's a pretty attractive price target there at 33 from Raymond James. Let's look at the charts and see how we might get there. Okay, this chart's looking all the way back before COVID, obviously. We see that COVID crash and the rebound. You guys who follow me know I like the Fibonacci retracements, and you can see this one's kind of perfect. We had the lows after COVID to the highs. We pulled the halfway back a couple times before it capitulated to the 61.8% retracement, just over 15. So, the market was pretty weak back then, and the stock hit these lows. But then bounced back quickly after their earnings and earnings and earnings. Every time they report earnings, the stock goes higher. And now we're in this nice trend upwards. So longer term, for you longer term guys, this is kind of a perfect Fibonacci setup into the negative 23.6 targets up here at 39. So your risk reward here is pretty good on any pullbacks as long as the stock were to stay over 15. Now, your shorter term guys, let's zoom in here a little bit. We see this is the same level here going back, and you can see the lows of 1589 made in there. The green line here is a 21-day. This is like the momentum moving average. The blue is the 50 and the red is the 200-day. So going back to the beginning of the year, we have the lows where we started to the highs. So I'm just drawing a micro fib from those lows to highs. We can see that we cracked the halfway back, didn't quite get into the 61.8, but we bounced from there, and this halfway back mark around 24, just below current levels, is found a lot of support. So if the market were to, I see two scenarios really here on the short term. If the market were to weaken, we might come into the $23 area, which could match up at that time with this rising 200-day moving average. And I think that'd be a great spot to enter. Or if the market gains some steam, we could break over 26. Either way, I like this setup as long as we stay over the 23. Maybe we see a flush in this 200-day moving average. As long as we stay in this area and support these this level from earlier in the year, I can see us going back up to the $30 area into the end of the year. So, and this is a great risk reward, right? You lean against maybe the lows of the year. If you can get 22, 23, you're risking 2 to 3 points to make 6 to 7 points. So great risk reward there on the shorter term. Bloomin' Brands has found its place in the casual dining market and has seen success despite macro headwinds such as inflation. For long-term investors, the stock is looking good on both the fundamental and technical sides. You have a technical long setup and get paid a nice dividend waiting for this setup to play out. I like that. Longer term, the bulls should expect the stock to trade back to all-time highs if the markets can continue their positive 2023 trend. Okay, that's it for me and my pick. Here is Brian Hayes with his.
Thank you, Jeremy. My top stock pick this week is a well-established lifestyle apparel company. I'm referring to Kontoor Brands, ticker symbol KTB. Kontoor Brands designs, produces, and markets denim, apparel, footwear, and accessories. The company is best known for its Wrangler and Lee Jean brands. KTB also offers apparel under the Rock and Republic brand name and primarily sells its products through mass merchants, specialty stores, department stores, as well as online. Kontoor maintains an international presence with operations in Europe, the Middle East, Africa, and the Asia-Pacific regions, in addition to the Americas. That's a bit about the company's background and services. Let's shift gears a bit and take a look at Kontoor's industry group. Digging deeper here, we can see that KTB is part of the Zacks textile apparel industry group, which is currently ranked in the top 43% out of approximately 250 industries. Because it is ranked in the top half of all Zacks ranked industries, we expect this group to outperform the market over the next 3 to 6 months. Quantitative research studies suggest about half of a stock's future price appreciation is due to its industry grouping. In fact, the top 50% of Zacks ranked industries outperforms the bottom 50% by a factor of more than 2 to 1. By targeting stocks contained within leading industry groups, we can dramatically improve our odds of success. We can also see other leading stocks contained within this industry group. This confirms that the industry is a good place to be, as several stocks are outperforming the market and are ranked highly by our Zacks rank. Also note the favorable characteristics for this industry group. Stocks in this group are relatively undervalued, while also showing above average projected earnings growth. Moving to our snapshot page here, Kontoor Brands is a Zacks rank #1 strong buy stock. KTB has delivered a 4-quarter average earnings surprise of 12.53%. They've beaten estimates for the past 3 years running, so there's a strong track record of earnings outperformance. Back in February, the company reported fourth quarter earnings of 88 cents a share, which was a 15.79% surprise over the 76-cent consensus estimate. So they've been consistently beating earnings estimates, and the stock price is reflecting this. The stock is up more than 18% this year, and despite the impressive move, shares remain relatively undervalued at just a 9.96 forward PE. Kontoor Brands also pays a $1.92 dividend, which translates to a very respectable 4.06% yield. Analysts covering the company are in agreement and have been raising full-year earnings estimates recently. The 2023 EPS estimate has been increased by 6.03% in the past 60 days. The Zacks consensus EPS estimate now stands at $4.75 a share, reflecting potential growth of 5.79% relative to last year. It's exactly the type of trend we want to look for when narrowing down our list of potential stocks. So it's obvious the growth is there for this stock and the momentum looks set to continue. So Kontoor Brands, ticker symbol KTB, is my top stock pick of the week. Make sure you subscribe to get all of our top stock picks. We bring them to you here each and every week on Zacks.com. From Jeremy and I and everyone here at Zacks, thank you for watching. Tune in next week for more of our top stock picks.